Sheila. How you doing? Good evening, ladies and gentlemen. We're gathered here at a time of increased debate and concern over our nation's current economic situation and future fiscal viability. You may have noticed that this subject comes up at some presidential debates and in the press that we're bombarded with. The national conversation over the last year has brought to the forefront the importance of reducing our national debt and deficit, decreasing the rate of unemployment, and increasing the growth rate of the economy. So several key issues are important to understanding our current position and the way forward. But there is broad agreement that the current fiscal path of the United States is an unsustainable one. We saw in the last 3 years the largest federal budget deficit since World War II. Within a few months, if our elected officials fail to take action, the United States will face drastic spending reductions and tax increases that are predicted to almost certainly create another recession in the United States, God forbid. However, in the longer term, action is necessary to reform policies on taxes, expenditures, growth, and to secure the country's economic future. Now, this is one of the key programs we have in the Baker Institute, and so we're delighted to host this event in our presidential election debate series. These are the vital challenges that the next administration must address, and which our two panelists will provide important insights this evening. First, let me introduce John Diamond, the Baker Institute's Fellow in Public Finance and one of the authors of the Institute's 2011 report, Fundamental Tax Reform, Then and Now, which argues that a sweeping reform of the nation's tax code is both necessary and achievable now. That's very important, necessary and achievable now. I can divulge to you that Secretary Baker gave a copy of their report directly to President Obama and to Secretary Geithner. The report examines the conditions that led to the passage of the 1986 Tax Reform Act, which was the last major effort to update the U.S. income tax system. John has also recently produced a report on the economic effects of a tax plan similar to the one proposed by presidential candidate Mitt Romney. I'm also delighted to welcome Russell Green, the Baker Institute's new Will Clayton Fellow. Russell joined us at the beginning of the year from the Treasury Department, where he was their first attaché to India. More relevant to tonight's discussion, Russell was previously the Deputy Director for International Monetary Policy at the Treasury Department, where he led their efforts to push the International Monetary Fund to label China a currency manipulator. Our distinguished moderator this evening certainly understands the importance of the economic and fiscal issues facing our country, and we're delighted that he could join us. Steve Miller is the chairman and president of SLM Discovery Ventures Incorporated. Many of you, of course, know Steve, which pursues commercial ventures in support of volunteerism, social outreach, and higher education academic achievement. He is the retired chairman of the board of directors, president, and CEO of Shell Oil Company. Active in the business and not-for-profit communities, he also serves on the boards of many important institutions in Houston and across the nation. He is a distinguished alumnus of Rice University. He graduated magna cum laude. However, from my point of view, Steve's most important position is being an active member of the Baker Institute's advisory board. And in this capacity, believe me, he enjoys keeping my feet to the fire. So please join me in welcoming both our speakers and our moderator for the evening. Gentlemen.
Looks like I'm first.
Oh, yeah.
At least I see my slides up here on the monitor.
Okay, there you go.
All right. Well, as the ambassador described, I'm an international economist, and the discussions in the campaign so far have not really focused on a lot of international economics issues. In fact, international finance, which I look at in particular, there are controversies in international finance, but they don't tend to break along party lines. And so when we were planning this event, I thought this would be a fun opportunity for me to branch out into an area that I don't normally get to look at a lot. But then Governor Romney mentioned that he was going to label China a currency manipulator on day one. And that happens to be an issue that I worked on directly, and so I thought I've got to talk about that. So I'll talk about that a little bit, and then I'll talk a little bit also about the debate on whether fiscal policy should be used for stimulus or moved towards austerity, and look at some of the international experience that might be relevant to the United States. So just to preview my assessment on the Chinese exchange rate issue. Essentially, I think this is one of these issues where candidates come out and make a bold statement that, when you dig deeply, really doesn't have much meat on the bone. On this, to sort of use a pun, it seems that Romney's a day late and a dollar short on the exchange rate issue, in the sense that there's just no economic case that can be made today that China is manipulating its exchange rate. Now, if this were the 2004 campaign, then you would have a strong case, but not so much today. So let's go here. So we'll start off with a little lesson. How do you manipulate your currency? So it's fairly simple. You want to keep your currency weak. When you keep your currency weak, that makes your products cheaper. And when your products are cheaper, you're gonna sell a whole lot more of them. Essentially, that's the whole point, is that it gives you a trade advantage by keeping your currency weak. But then the question really, I guess, the essential question is, how do you keep it weak? What is it that a government does to weaken its currency? Well, the most basic thing that you do is you sell your currency and you buy other currencies. So, this is basic supply and demand, right? If I sell a whole lot of something, the price is going to go down, and when I buy something, the price is going to tend to go up. So you make in this case, the renminbi cheaper relative to the US dollar. And in China's case, they're buying mostly dollars because, of course, the US dollar is the currency that they're pegging against, that they track. And so if there's any students from my class in the audience today, I hope you're taking notes. We have a midterm coming up. All right. So the net result is you wind up with a lot of dollars. And in China's case, it's $3 trillion worth of international reserves, about half of which are US dollars. Most of that is US treasuries, although there's also a good portion of it that they've acquired in mortgage-backed securities. And in fact, China's become the third largest holder of US treasuries after the Social Security Administration and the Federal Reserve. China's next. So we know how you manipulate your currency. Now, how do you label somebody a currency manipulator? Well, briefly, after the collapse of the Bretton Woods system, when Nixon took us off the gold standard in 1971, we created the International Monetary Fund needed a way to create rules for floating exchange rates, because we really hadn't had floating exchange rates. And so the IMF Articles of Agreement established this language that basically all the IMF member countries agreed to, that each member shall avoid manipulating exchange rate to gain an unfair competitive advantage over other members. This essentially set the ground rules, and the concern was exactly a China-type situation, that a country with a large trade surplus would be able to manipulate their currency to keep it weak for the disadvantage of other countries. So then in 1988, partially in response to to the surge in Japanese exports, the Congress passed a law that essentially used the same language as the IMF, but it gave the Treasury the authority to look at whether there were countries that were actually manipulating their exchange rate and send a report twice a year to Congress to let them know if they'd found anybody to be a currency manipulator. Essentially trying to give the IMF some teeth. The IMF is basically just a member, a supranational organization that can't impose its will on any country, but perhaps U.S. Congress has some tools to force compliance more than the IMF does. But the fact that the U.S. law is using the same language as the IMF means essentially that the Treasury Department looks every year at whether the IMF has determined anybody is a currency manipulator and then passes that report along to Congress. It does some of its own analysis, but essentially the IMF is what gives the official objective determination of currency manipulation. So that means it'd be a little awkward for the Treasury to go out in front of the IMF or for the U.S. government to go out ahead of the IMF and label somebody a currency manipulator before the IMF has. And that's one reason why the Bush administration, the most recent Bush 43 administration, did not decide to label China a currency manipulator. Instead, we put a lot of pressure on the IMF to try to get them to, unsuccessfully in the end. So let's look at the evidence for China as a currency manipulator. So this is the sort of the early period when China had a peg to the U.S. dollar. You can see there's absolutely no currency movement of the red line is the Chinese currency relative to the dollar. Absolutely no movement. During this period, it's pretty clear that China is manipulating its currency. Most economists who looked at it at that point felt like there was about a 25% undervaluation of the renminbi relative to the dollar. But then in 2005, they started to slowly let their exchange rate appreciate. This was about the time that I joined the team at the Treasury that was looking at this, although I'm not taking credit for this movement. The other thing to note is the blue line is the percentage change in China's international reserves. So as we said, the process of manipulating your currency is you're acquiring international reserves, and you can see that China's acquiring reserves at about 2 to 3% per month through this period from 2003 through about 2007. That's about 25 to 40% growth in their reserves per year, which is how they got to the point of having $3 trillion worth of reserves. Okay, so then I guess the other question is, if it's really obvious during this period that China is manipulating their exchange rate, why didn't we label them at that point in time? Well, besides the fact that the IMF hadn't, the other reason is that when you label somebody a currency manipulator, you're essentially giving Congress carte blanche to do all sorts of protectionist measures to counteract that currency manipulation. It's essentially carte blanche to start a trade war. And even with a Republican Congress during this period, the Bush administration felt very reluctant to give that sort of signal to Congress to go forward and punish China in a trade way. Let's see. So then finally in 2007, they start to really allow the exchange rate to accelerate. This is where I'll take credit. No, but not really. But what you see, though, is that their reserve accumulation in this period is still in that 2 to 3% range. So even though the exchange rate, the renminbi is starting to really strengthen, clearly China is still manipulating in the sense of it's having to intervene in the market to keep the currency from falling even faster. So then, then the financial crisis hits. Everybody kind of forgets about this issue for a little while. But what's happening today? So if you look first at the blue line, you'll notice that reserve accumulation is now occasionally going negative, which is, in fact, for the entire first half of this year, we don't have statistics yet past June, but from January to June, there's essentially a net decline in China's international reserves, which means it's impossible that they were manipulating their currency in a physical sense in the markets. There was in fact a net movement to strengthen the renminbi. Now, oddly enough, you don't see the renminbi strengthening over this period, in part because people are now so concerned about a hard landing in China, some sort of a bad economic downturn, that money's actually starting to come out. It's no longer pouring in. And then when you look at what happened on trade, the red line is the bilateral trade balance. You can see that through the entire period of currency manipulation, through the entire period of the pegged exchange rate, our bilateral trade balance was worsening or improving in China's favor, worsening in our favor. Once they start to allow a little bit of flexibility in the exchange rate, it turns the other direction, but still a large trade deficit from the US perspective with China. But the point is that today, our trade balance, and in fact China's global trade balance, has moved significantly back towards normal. Now, given the structures of our economy, we wouldn't expect it to necessarily go to zero, but it's difficult to argue that there hasn't been a dramatic improvement in the trade balance with China. So essentially, my argument is, as I already said, that it's very difficult to look at the numbers and make a case today that there's any point in labeling China a currency manipulator. All right, so I thought next we would look at what's going on internationally in this debate whether countries that have high debt levels should be pursuing a stimulus measure to get their economies growing, or whether they should be pulling back their deficits and trying to impose austerity in order to regain, sort of work on their national balance sheets and regain fiscal health. So the essential question is your long-term growth better when you have more deficit reduction or more deficit spending? And the basic argument for deficit reduction is that if you have a very high debt level, it casts a very long and dark shadow across your economic growth. Everybody's worried about this debt level, and therefore long-term economic growth suffers. So you're actually better off if you pull back the government a little bit, which does, pull some activity out of the economy, but that debt reduction that you get essentially is a stimulus of its own by improving confidence in your economic viability long term. On the other hand, the argument goes that if you have a very weak economy, if everybody is credit constrained, they would like to spend more, but either because their own balance sheets are bad, or in the US case, because our banks' balance sheets are bad, people aren't able to borrow, then the government is essentially borrowing on behalf of everybody else and spending and giving some stimulus to the economy. The other issue is whether long-term unemployment that could happen because of a recession may have permanent effects, as people are unable to re-enter the job market when the economy improves, and those long-term effects, trying to avoid those long-term effects, are worthwhile to go ahead and do a little extra deficit spending, even if you already have a high debt level. Now, this debate seemed a little bit more relevant when we were in the primary season, because you had candidates that were taking much more extreme positions, and I think we've had a bit of a shift to the middle. Looking at the debate last week, it seems like there's not a whole lot of, it's difficult to say any one candidate is pro-austerity or pro-stimulus. So maybe this whole debate is only, still going on in the minds of Ron Paul and Paul Krugman. But when you think about, we still have this fiscal cliff that we're all worried about that could impose austerity on us, whether we want it or not. We still have the European crisis hanging out there that, if it really blew up, could put us back in a situation of really facing this issue. So it's still relevant to our economic policy making, even if the two candidates aren't staking out stakes. So let's look at what the international experience is. Well, if you look at Europe, this graph essentially tells you on the horizontal axis how much have countries tried to cut their deficits. This is looking at all EU members. The red squares are countries that have had slow growth, so growth where it's 2.5% growth or less from 2009 to 2011. The blue diamonds are countries that have had better growth than that. And then on the vertical axis, you have the actual change in their debt to GDP ratios. So the horizontal axis is how much they tried to cut their deficit, and the vertical line is how much they actually succeeded in lowering debt levels. So ideally, you'd like to see everybody in the lower right quadrant. Everybody tried to cut their deficits, and they saw an actual reduction in their debt levels. But instead, we see everybody in the upper right quadrant, which is really discouraging. Essentially, everybody in Europe tried to cut their deficits, and instead their debt to GDP levels have gone up. And essentially what this says is that at times of recession, the amount of money that you're spending, your fiscal stimulus, has a multiplier that's greater than 1 for 1. And so by cutting back on their fiscal activity, what's essentially happened is that the economy has slowed down more than 1 for 1 to that cut in GDP, and they haven't been able to keep up with their debt levels. So debt levels have suffered because essentially revenues are impacted more than 1 for 1 by doing cuts. So it's not a very encouraging sign that austerity works at times of recession. In fact, it could be one reason why, in general, you find the result that high debt levels are bad for economic growth. It's actually reverse causality that a country in the middle of a crisis sees this high debt level, thinks, gosh, I better bring that down, tries to cut back their deficit, but because they try to cut down their deficit, in fact, they wind up slowing their economic growth, and their debt levels rise more than they expected. And so the causality actually goes from trying to cut your deficit during a crisis to high growth, as opposed to the debt level impacting your economic growth. So then briefly, and I'll just wrap this up, if you look at the evidence, say, across the OECD countries, which is a group of advanced economies that range from the US and Germany down to Mexico and Turkey, if you look at the evidence, if you're going to choose austerity, if you're going to try to cut your deficit, try to cut spending rather than taxes. The main reason why this is the case is when you raise taxes, it's just too tempting to try to spend that money that you just earned and not use it to pay down debt. So the reality is, if you want to have a meaningful debt reduction, go for spending cuts over tax hikes. But if you want stimulus, you should do a balanced budget stimulus. And that is to say, raise spending and taxes the same amount. But during a recession, like I said, your fiscal stimulus, you get more than 1 for 1 bang for the buck, where taxes have less than 1 for 1, because part of what you're taxing is money that people would have saved rather than spent. So you can do an equal tax increase and spending increase and still get a stimulus to the economy. And then which should you choose? Well, if you're really highly indebted, if you're Italy, if you're Greece, if you're maybe Ireland, then you really need to think about austerity. But pretty much the evidence seems to show that anybody else, especially countries that have low borrowing costs like the US or the UK, could probably afford to do a bit more on the stimulus side. All right, so I'll stop there. And
all right, thank you. It's a pleasure to be here. So tonight I'm going to talk about the budget situation, which can be a little dreary. And so we're just going to jump right in as soon as I figure out how the clicker works. There we go. All right, so to start out, I'm going to have to to talk a little bit about why baselines are important in economics. So if we want to look forward and talk about how policies now will affect our economy and our tax collections and our deficit in the future, we first have to talk about, well, what does the present look like? What does our current baseline tell us about this period and the periods to come? Now, choosing a baseline, it's real easy just to say, I'm going to plot my baseline, but when you actually have to choose your baseline in the messy world of policy, it gets very complex. And so I'm going to present, and CBO and other policy institutions usually present two baselines. And we'll call one the extended baseline, or they call one the extended baseline, and one the alternative baseline. Other names for them have been, the alternative baseline is often called current policy. So that's actually what people tend to do time after time after time. Congress tends to always pass the temporary research and development tax credit. So to pretend that next year they're not going to pass that credit after they have the last 10 times is probably not very real thinking. So the blue line, which is the extended baseline, which is current law, so that's whatever law is on the books, is often kind of a fairy tale baseline. No one really thinks that's going to happen. But for decision-making purposes, it's the baseline that is used. The importance here is that for congressional purposes, the extended baseline is just meant to compare policy proposals against some baseline. No one takes it as an actual forecast of where we think the economy is going to move based on policy decisions, because we recognize that there's a lot of policies that will change, relative to this. So we have to define this idea of a baseline, and we need to define each baseline before we can talk about the problems we face. So the extended baseline is current law. And under that, we would assume that several temporary policies, so laws that have been passed for a temporary period of time, will actually expire. That Congress will let those laws expire and they'll no longer be relevant. So what are some of those? Well, one is pretty much the entire tax code is a temporary policy. The 2001 and 2003 tax cuts have shifted the tax code along a much different trajectory than they were prior to 2001. If we allow the 2001 and 2003 tax cuts, the Bush tax cuts, or the Bush half-Obama tax cuts, whatever you would like to call them, if we allow those to expire, our tax code would look very different. And in fact, if we allow them to expire, taxes as a share, revenues as a share of GDP will increase well above the 18.5% average over the last 40 years. The AMT is also another temporary policy. So this was a policy that was passed in around 1969, and its intent was to make sure all rich people pay enough taxes. If it's sounding familiar to other policy options that are being tossed around out there, such as the Buffett rule, well, it should. That's exactly what it was. It was the Buffett rule 30 years ago, and now it's just a failed policy experiment because we didn't index it for inflation. And so over time, economic growth and increases in nominal incomes have pushed more and more people onto the AMT. So it no longer just affects the rich, it's affecting a lot of people. In fact, it would affect a lot more if Congress didn't pass AMT patches or modifications. They increase the amount of the deduction available under the AMT, which, stick with me here, is just an alternative tax system that's available for U.S. taxpayers to try to figure out if the current tax system isn't complicated enough. So another thing you hear a lot about is Medicare payment cuts to physicians. This is a temporary policy, so it seems like every 2 years we talk about whether we're going to allow physicians to receive less money, Medicare physicians to receive less money. Ultimately, Congress always passes an extension and says, no, we're not going to cut payments to Medicare physicians, and there's good reason for that. Another new temporary policy is the Budget Control Act of 2011. And this is a very interesting policy, at least one that we should be interested in at this point in time. So this is the sequester, and it will take effect come January 1st, 2013. And in 2013, so it's a 10-year policy, and the Budget Control Act would cut $1.2 trillion from spending over a 10-year period. In 2013, it would cut $109 billion, and I've kind of broken it apart from you so you can see how those cuts would come in 2013. So it'd be about $55 billion from defense, $11 billion from Medicare payments that would go to providers, and $43 billion in cuts to other spending. So this is the extended baseline. If we really thought that all of this was going to happen, that at the end of 2013 we were going to allow $109 billion cuts in spending, and we were going to allow the Bush tax cuts to expire, which would be about $700 billion, leading to about an $800 or $900 billion fiscal hit at the beginning of the year, then this may be a reasonable baseline. However, we don't think any of that's true, or I don't think any of that's true, and neither does CBO, or neither does any other real policy wonk out there in the world. So we have this other option to choose from, the alternative baseline. And it just extends almost all current policies. And so under the alternative, we would extend the Bush tax cuts forever. We would never cut payments to physicians under Medicare. We would throw the Budget Control Act out the window. And other policies that restrain spending, we would just get rid of them too. So really, we could name these. One is, for my kids, I would tell them that this one is the cookies and milk every night at bed, and the extended baseline is the take your medicine. Because if we go back, now that you have a little more background, the blue line is the extended baseline. So if we actually allow the taxes to increase and we impose these outrageous or some hefty spending cuts, the budget actually looks pretty good. By 2072, we'd have 2070, we'd have no budget deficit, and 2086, we're running a budget surplus. In fact, the U.S. doesn't own any debt; it's actually buying other people's debt. We could possibly be a currency manipulator, I think, at that point, if we started accumulating enough reserves. That would be a beautiful thing. Now, the red line is the alternative baseline. This is a much different world that we would live in. And you could see that we would start out now at about 75%. So these are public debt held by the Treasury. I'm ignoring the debt that the government owes itself. And I'm just looking at the debt that the government owes to other people. Now, is there a good reason to ignore debt the government owes itself? No, not really, but a lot of the data is presented like this. So, but I think things are bad enough in the red line, even if we just look at the debt that the government owes to other people. I mean, we would own, so the debt would be 250% of GDP in 2042. Wonder how that would work for us. So that's the thing about these baselines, is it doesn't tell us what this would really look like. It's just a red line on a chart. So maybe we'll look. I wonder what it would look like. Well, here's some other lines that CBO published. So all of this is from the CBO's latest long-term budget outlook. So the red and the orange lines are related to the alternate baseline, and the blue and the black lines are related to the extended baseline. Now remember, let's start with the alternate baseline, because that one looked really bad. I mean, so we must have not been collecting any tax revenue and spending just tons of money in order for things to be that bad. Well, what happens under the alternative baseline? Well, the orange line is spending under the alternative baseline, and we can see that that is increasing rapidly. Now, most of that is just interest payments on the debt. As our debt increases, we have to spend more and more on interest payments in order to keep our creditors happy. And the only problem is that under these baselines, we're assuming that we get to keep paying really low interest rates, and that at some point in time, people wouldn't start asking for more and more interest in order to lend us money. So it's still somewhat of a fairy tale. So spending would actually increase to about 35% of GDP, and then our problem is that as we keep running a deficit, our interest payments are increasing very quickly in about 2044. So they would already be, in 2044, interest payments would be about 11% of GDP, opposed to the 2 or 3% that they are now. So let's switch over. I mean, this looks okay. Well, what about taxes under the alternative baseline? So spending is going up quickly. What are our taxes? So we must not be raising much in revenues. Well, no, that's not the case. If you extend all of the Bush tax cuts and you make them all permanent and all of the other revenue things, you actually end up with revenues equal to 18.5% of GDP from here into the long term. It would bounce around a little more than it's drawn here. But we actually end up collecting about 18.5% of GDP, which happens to be the average we've collected over the last 40 years. So revenues are fairly reasonable under the alternative baseline. And what about under the extended baseline? Well, here spending actually isn't that bad. You can see that spending, well, I guess that bad depends on who you are. I actually think this is atrocious, but spending increases from the current rate. So the average 40 years, so if you look back 40 years, on average, the U.S. has spent about 18.7% of GDP was government spending. Beginning in 2008, that jumped up a lot with TARP and other emergency measures to deal with the financial crisis, and so that went upwards of 25%. It's been coming down just a little. We can see that it's going to kind of settle out, assuming that all of the spending under the TARP program and all of these temporary stimulus spending measures that have been adopted are actually allowed to die or to go away. Spending would go down until 2020. It's about 21, 22% of GDP, and then we see a gradual increase of spending over the next 60 years. And that's basically just the population aging. As the population ages, we have to spend more on Medicare, Medicaid. We have to spend more in terms of Social Security. So it's A, population aging, and then B, medical costs are increasing at a faster growth rate than GDP. So not only is medical spending or health spending increasing because of changes in the population, but it's also increasing because medical costs are growing faster than GDP. So the blue line just shows those two things happening, and spending goes from about 22% to 26%. Now our taxes under the extended baseline, so if we get rid of the Bush tax cuts and we just allow those to go away, our tax take goes from about 18.5% of GDP in a fully employed economy and it gradually just increases and increases and increases, and by 2080 we'd be at 30%. So taxes as revenues as a share of GDP would be 30%. That's basically adding, that's twice the amount of revenues that we raised this year, and it would be 12 percentage points over what we would raise in a normal year. That's more than adding a full income tax structure on top of the income tax structure that we currently have. So individual income taxes raise anywhere from 8 to 10%. And so if we're looking at boosting our revenues as a share of GDP from 18 to 30%, we would have to come up with a whole new income tax structure to do that. And I'm sure government bureaucrats could find a way to do this, but that's another issue. Now, there's a problem in that we haven't really, in these projections, we haven't allowed for any economic effects, but yet we know that if you want less of something, all you have to do is tax it. And so if we actually started taxing income, raising or into taxing sources of income, we would expect less income. So let's look forward. So what do we see in the literature on the effects of taxes and tax rates and revenues and GDP growth? So here's some work I did with a colleague, Alan Viard. I also have done similar work when I was at JCT looking at this same question. What are the effects of cutting tax rates for different types of income? So is a wage, if I cut someone's marginal wage tax rate, is that the same as cutting the rate they pay on dividend income? Is it the same as increasing a tax expenditure, say doubling the child credit? And what are the effects? So whenever you think about this, the first thing you have to do is think, well, what am I going to do with the revenue? Or alternatively, how am I going to pay for a tax cut? If I'm going to cut taxes, then I'm going to have a larger deficit. I know the larger deficit is going to crowd out private investment, which would lead to lower GDP growth in the future. If I don't want those effects kind of clouding my analysis, then I need to make some assumptions. So I'm going to make two assumptions. I'm going to start with the simple one, which is for every dollar in tax cuts, we reduce spending by $1. And that way the budget stays balanced, assuming that it's balanced when you start, or at least assuming that it's growing along with GDP. So in this case, it's pretty easy. In terms of immediate effects, the wage cut has the biggest effect. If you cut wage tax rates, we get an immediate increase in GDP of about 0.3%. All of the other tax cuts are, over here in 2007, are pretty low. So I'm assuming, I started this in 2007. I was using a large-scale general equilibrium model. I needed a good data point to start out on. 2007 data is better than 2008 to 2012 data. And so I took that. Plus, I did this in 2008 or 9. So in the short term, cutting marginal tax rates would have the biggest effect on GDP. But in the long term, so if you allow the effects to accumulate over time, cutting dividend and corporate tax rates. So the dividend tax cut is the green line, and the corporate tax cut is the purple line. So if you cut dividend and corporate tax rates, that would have the biggest effect on GDP in the long run. Wages also have a positive effect. You can see that cutting the interest income tax or increasing tax credits really doesn't affect long run or short run GDP very much. So what if instead of cutting spending, and the offset is always a big issue, so let's not handcuff ourselves to a spending offset. What if instead we cut tax rates now and we're going to deficit finance them for 10 years, and then we're going to raise tax rates across the board after 10 years to balance our budget and hold debt to GDP constant? So this would be something similar to what happened in 2001 and 2003. We passed a large tax cut that wasn't paid for. We went out 10 years, about 2001 to 2012, and now we're asking the question, should we cut spending to pay for them, or should we raise tax rates to pay for them? Well, what happens? Well, we can see that all of them eventually lead to negative GDP, at least relative to the baseline. So if you deficit finance tax cuts for 10 years, if you cut taxes, you allow the deficit to build for 10 years, and then you come back and raise all tax rates equally across the board, you're going to end up with a reduction in your GDP relative to where you would have been if you would have just done nothing. So, and in fact, if you have a tax credit, you're in really bad shape. You're almost a full percentage point of GDP is cut off, and you can see that it goes up with the dividend tax cut being the most powerful. You get the most feedback effects from cutting dividends and corporate taxes in this case. And then in this model, I can actually look at welfare, and I can look at welfare across different generations. It's always important to think, and I can actually look across income groups as well. And so it's always important to think about if I'm doing something now, how does it affect current generations? How does it affect future generations? Well, if you cut taxes now and you build up a debt and you postpone paying for it until 10 years later and then you raise income taxes, it shouldn't be real hard to figure out what happens. People alive at the time of the reform are better off. They get to consume more of their income. People who are born in the future are worse off. We're passing the effects of the deficit on to them. And now, for each dollar they earn, some portion of that dollar is going to have to go to paying the principal and the interest of the debt. So to bring this all down to kind of a real world level, so what's going on? Well, there was an interesting study by Ernst & Young in July of this year, and it looks at at what would happen if we allowed higher top tax rates beginning in 2013. So I mean, let's kind of look at two policies that would look like the policies that have been proposed by our two candidates. One wants to raise taxes on high-income people. He wants to extend all of the tax cuts on those making under $250,000. The other has offered a proposal to have a broad-based, low-rate tax system. So we'll just look at each of these very quickly. So what happens under the Obama plan? Well, under the Obama plan, wage income tax rates on the highest income groups would increase from 35 to 44.7%. And this is, this study only looks at the top end. The dividend income would increase from 15 to 44.7%, the dividend tax rate. And the capital gains rate would increase from 15% to 24.7%. So the important thing is the dividend tax rate increases by almost a multiple of 3. I mean, that's a huge increase. And generally in economics, and I think in current tax policy, the guide has been reducing taxes on capital income, not raising them. So what did Ernst & Young find? Well, they found that if you cut spending, if you passed these higher taxes and cut spending, output would decrease by 1.3%, employment would go down by 0.5%, investment would fall by 2.4%, the capital stock would be down by 1.4%, there'd be some international capital flows making up for the difference, and real after-tax wages would decrease by a percentage point, or by 1.8%. Now, the spending offset isn't the only option. You could have a tax offset as well. So they assumed, what if instead of the spending offset, you did an across-the-board tax rate reduction? So you lowered everyone's taxes. So you increase tax rates on the rich, and then you go back and you lower everyone's tax rates by an equal percentage in order to spend all the income you raised with the tax rate increase. In this case, you get a negative, output falls by 0.4%. Employment is up slightly, investment falls, and real wages go up just a little bit. What Obama has proposed is actually somewhere in between these. He's not a full spending offset, he's not a full reduced taxes. So there's going to be some tax spending in the form of increased child credits and other inframarginal stuff like the 10% rate bracket and expanding the brackets for married individuals, as well as some rate reductions in the code. So we're somewhere in the middle. So what about the base-broadening rate-reducing reform? Well, I'm not completely impartial here. I actually proposed a broad-based rate-reducing reform in January 2011, long before Governor Romney had come out with his plan. I've been a proponent of such a reform for a long time. I've done work for the Romney campaign on various policy proposals that they should look at, and this paper was part of that, in which I was giving them some guidance on various issues they should consider in terms of the economic effects. And what I found is that for a very clean, base-broadening, rate-reducing reform that included reducing the corporate income tax to 25% and paying for it by closing corporate tax preferences, getting rid of things like the non-taxation of interest on government bonds, on state and local bonds, getting rid of other corporate tax preferences, but keeping investment preferences, so basically accelerated depreciation. I found that GDP would increase by 6% in the long run, and employment would increase by 5.5%, which would be this is hours worked, and if you split that into its participation rate, so how many more people would work, and its hours worked response, just people working more hours at their current job, I found that would be equivalent to about 6 million jobs in period 10, or 10 years after the reform was enacted, and that's 6 million jobs above the baseline in the initial thing, and that number has received a lot of press. I've made lots of friends and I've made lots of enemies, so that's part of life. The distribution of income is also important, but I'll stop here. I mean, these are just some figures we were going to talk about, but we can talk about that more, and I'll stop here and let y'all ask some questions.
Thank you, John. Would you just join me in thanking our two speakers? I thought we'd do that, guys, before we got to the midterm exam. You noticed the reference that we had from Russell about a midterm exam. I hope you would kind of think about this is the opportunity to give our speakers the midterm exam. I know I always relish this kind of an opportunity to be able to tap into some great thinkers and to begin to bring it from some of the theory into actually the practical. And so for the next 30, 40 minutes or so till 7:30, the time is really yours and mine as moderator. The process we'd like to use, you'll notice there are some microphones on each of the aisles. When you have a question, if you'll come up to the mic, identify yourself and ask the question. I'll start with one question while you're just getting ready to think about it, but there was a couple comments about CEOs out there in the audience. There's also one sitting right here. And one of the things that you think about as a CEO, in fact, this is common in every one of the board meetings that I am, because we're not thinking about 2072 or 2044. Most of those board discussions about that far off period called 2013. And so one of the things that's hotly debated in the boards is what happens actually in 2013 if we really do go over that fiscal cliff? And how would you handicap that happening since we're about 90 days away from it? Russell, would you, and then John, jump in.
So, I think I would probably say that I put the odds of answering the first question, the second question first. I would put the odds as fairly low. And the reason I do is because I think the answer to the first one is that it would be pretty severe. I think, from John's presentation, you saw the magnitude of the fiscal impact that we would have. As I indicated in my presentation, you get a much bigger impact from changes in spending than you do from changes in tax levels, and all of that would come, well, not all of it, but you'd have a dramatic reduction in federal spending. And so you would wind up having an impact on the overall economy that would be, the fiscal multiplier in the situation is greater than 1. So you have an impact on the economy that's much greater than the actual numbers would suggest. And so I would say that We obviously are going to have to see the outcome of the election because we're not going to have any movement on this until the election. But I think there's a good history of lame duck Congresses listening to elections and actually moving on stuff, moving on important issues when they really have to.
John?
Yeah, I think that, I mean, it's impossible to ever predict what Congress will do, is the one thing I learned working for Congress. I do think the election is important. I think if Romney's elected, we'll quickly see a temporary punt and probably something with a 6 or 9 month extension in order to give his administration a time to lay out and create a policy. If Obama's elected, I think it's a little more hairy. I don't see the way out necessarily because relationships are so bad between him and the House Republicans. I don't know who's going to, I mean, for there to be a compromise, someone has to give. And they're two almost opposite viewpoints, and I don't really see either one giving. So I'm not as optimistic in that case, although the price of not, someone will flinch. It's the famous game of chicken at that point. We have two cars driving towards one another, and one of them's going to have to flinch. You know, but if it did pass, so what would be the effect if we did go over the fiscal cliff? Well, it would be bad, but not that bad. I mean, what's really bad? I mean, it's a short recession. I think most economic forecasters would think that GDP would fall below the current rate. It may fall to -1, maybe -1.5%, but would be back above positive growth by mid-year. I mean, CBO predicts that if we had that, you'd get about -0.5% in the first half, and you'd be back to 2% growth in the latter half of 2013, and that may not be the end of the world. I think the problem is where the cuts come from. It's do the Republicans and do the Democrats want to allow $55 billion in defense spending to be cut at a time when our forces are being asked to do a whole lot? I think that's the real. There's some real political challenges there that they're going to have to face. So, all in all, it's very uncertain but very interesting.
We came out with the same conclusion at our last board meeting. It was difficult to call, but I appreciate the perspectives that you offer, because that's the world we have to navigate through. So we'll take questions. We have a question? Yes, sir.
Yeah, I have a question for Professor Diamond. The key of your argument is that reducing tax rates leads to these big effects on labor supply and capital. And I guess I missed it, but what happened after the Bush tax cuts? We didn't seem to see a very big, increase in employment and an increase in investment. And so I guess, of course, that's what everybody trots out there, and they say, well, when we had the high taxes under Clinton, things were booming. So, number one, what's your sort of short answer why that experience isn't relevant, or why you get your results when that recent experience seems to be, what we've seen? And a second question is, politically, the Reagan broad-based tax cut worked because he raised taxes on corporate America while reducing them on, individuals. So politically it worked, but how would you politically have enough winners to enact the broad-based reform that you've advocated?
Oh, that's a lot of stuff. So let's just start with so Bush tax cuts. Did they work? Did they not work? Like I said, the Bush tax cuts, you have to look at them. I mean, in the policy world that they were passed in. I mean, my results actually tell you why they didn't work. They were deficit financed, and a deficit financed tax cut. So if you cut taxes on investment, and if you look back, they're actually what led the recovery out of the Bush recession. It was strong private sector investment. That's because we cut taxes on capital income. Well, why didn't that continue? Well, because we deficit financed it. And so you had, at the one point, you had the positive effects of a tax cut, but on the other hand, you had the negative effects of crowding out. And crowding out is just when the government has to borrow from the private market, it's competing with the private sector who wants to borrow in the private market. As interest rates get pushed up, that reduces the gains that you'll see from investment. So the fact that the Bush tax cuts were negative, were deficit financed, tells me, and in fact, if you look in 2003 when I was working for the Joint Committee, we did the first dynamic score of the Bush tax cuts, and what we found was so they were passed in 2003. We scored by 2008 they would be having a negative effect on GDP, and that report was used by every Democrat the day that the 2003 law was voted on. And so I think that the deficit financing. As far as Clinton, this is an interesting one. I'm always annoyed by by people who, not people, but by the question or by this thing that if you raise taxes, everything's going to be better. All we have to do is look at the Clinton years. Well, that's not necessarily true. We raised taxes in '93 and things were still pretty bad all the way to '95. At that point, productivity in the U.S. skyrocketed due to just these effects of new technology and so forth. But the really big point was we did cut taxes. Clinton did cut taxes. He cut the capital gains rate in '97. So it's not clear to me that you can argue that he raised taxes on high investment people. The other thing that was going on in the Clinton years is, remember prior, so you're exactly right on the 86 Act. We paid for 8 percentage points of individual tax rate reduction through closing loopholes on the corporate side. So you increase corporate taxes in order to pay for a reduction in individual taxes. So the effective corporate rate went up. And so what you had post-Clinton when he raised the individual rate above the corporate rate was you had people shifting out of the individual side to the corporate side. So their rate really didn't go up because all they did was shift from being taxed as individuals to being taxed as pass-through entities, LLCs, LLCs, subchapter Cs. In order to get the corporate tax rate at 35%, you had the lowering of the corporate tax gains, and then you also had this. There was an extraordinary boom. There was a bubble brewing. So I wouldn't. I guess there was so much going on. You kind of have to look at in order to determine the effect of tax rates on the economy. You would need to do an econometric exercise which looked at all these different things and how they're going on. And people have done that, and the model I use uses reliable estimates on the elasticities of supply for these variables that are within the reasonable parameter ranges. And lastly, politically, how do we get there now? How do we get to 86 now? And that's a great question. It is harder to some extent from 86 because we don't have the corporate revenues to lower individual rates and therefore to create winners. The thing I would say is it's more imperative now that we come to a compromise on this. And there are a lot of bipartisan solutions, Simpson-Bowles, Domenici-Rivlin. There are a lot of plans similar to the plan that I laid out with George Zodro that are just different in minor ways. And my plan, I'm more than willing to give on a whole host of areas. But I think there's a more, I just think there's a greater sense that we have to do something than there was in '86. And so I'm hoping that'll be which brings us to tax reform. Although what Secretary Baker says is that the most important thing is presidential leadership. And I honestly believe that if we had a president who would make this his #1 issue and spend his political capital to see this through and was willing to take some really tough hits in the process, that it would be politically feasible. Although recently I was stayed in the Atlantic saying the opposite, so, you know.
Okay, great. We have another question over here.
Just a segue into the same issue. The criticism of Romney's plan is that it just doesn't make sense from a deficit perspective because he wants to lower taxes, he wants to raise spending on the military, he wants to lower spending in general, and the argument of the Democrats is that it leads to larger deficits, and that doesn't seem like the right solution. And when you talk about things like Simpson-Bowles is willing to increase revenues while reducing expenses, and the Republicans aren't willing to have never been willing to say that they would go along with increasing revenues while lowering spending. So, and that seems to be, although it wasn't necessarily stated in the debate, maybe as well as it could have been, the criticism, what Romney is saying is that it doesn't work, and it doesn't work in a big way. So how does it work? Because you obviously are one that believes that you can lower taxes. You don't really talk about other things about the deficit. And just one last thing. I was at the meeting that you all had on corporal taxes, and what I got of all that was that if you lower taxes by 25% of corporate taxes, and you do that by having to eliminate a lot of these deductions, whatever they are, depreciation, oil, the benefits for the oil companies, at the end of the day, it doesn't have much effect on the GDP. It basically was a net sum zero game. That the offset of all, and you don't say that, but that's what I got out of that meeting, and you were at that meeting, but I didn't hear that at all today, and that seemed to be one of the things that I got out of that meeting. So I guess in general, I hear all the things about all these things about taxes, and frankly, you just said before that maybe all these things about taxes aren't even relevant to what goes on in the economy. That the economy does things like in the Clinton years, the economy progressed maybe despite, it did all that stuff despite the fact that we raised taxes because of all of other things that are going on in the economy. And maybe the same thing is true now, that if we raise taxes a little bit and had other things happen, the economy would be better. But I think the basic question I have is, well, how do you come down on this whole argument about the fact that the Romney plan doesn't seem to work because the effect it has on the deficit?
So I agree that other things are important. If we could have an internet boom with technology stocks going, with the NASDAQ going from 2,000 to 5,000, I agree things would be better off and taxes would be a pretty small issue. I doubt that's going to happen. But that's the kind of thing you have to account for. It doesn't mean taxes are insignificant. It just means taxes are one piece. And sometimes they can be overshadowed by things that are having larger impact. So you can't assume that just because we had a bubble in the market, that tax rates, that then the new result is that higher tax rates lead to higher economic growth. On the corporate tax rate, I agree completely. You actually were spouting off the findings of my own paper. So you're right. If you cut the corporate tax rate and you pay for it by getting rid of all corporate preferences, and including the preference for accelerated depreciation, the net effect is a zero. It's actually a negative. It's a negative 3% of GDP, negative 0.3% of GDP. And the economic reasoning behind that is if you cut the corporate tax rate, you're cutting taxes on both new capital, new investment, and all old capital. So the bang for the buck is smaller than it is for an investment tax credit in which you're giving the tax break only to new investment. And so if your trade-off is lower the rate and get rid of accelerated depreciation or the R&D credit, then that's not a good trade-off. But one of the other results in the paper was that if you can lower the rate to 25%, and only get rid of non-investment related expenses, so you keep accelerated depreciation, then you get about 1.25% growth in GDP over the long term. So that was that result. I completely agree. A trade-off of investment credits for rate reductions, not a good trade-off. But if we can close production credits, so Section 199 production credits, which allows is a big break for oil companies and other manufacturers. So that's a production credit mainly geared toward manufacturers. If we can get rid of that type of stuff and use that to bring down the corporate rate, we would be better off. And then lastly, the Romney plan. Well, the Romney plan is deficit neutral. It's a rate. I mean, Romney's idea is going back to, I mean, this is almost supported by every economist, which is if you have a broader base and lower rates, it's more efficient than if you have a narrow base and higher rates. That's efficient. I'm not saying that's more fair. Fairness and efficiency are two different issues. So all tax policies should be looked at on three issues. Is it efficient? Is it simple and administratable? So can we administrate it? Can the IRS enforce it? And then is it fair? And on the efficiency issue, a broad-based, low-rate reform is more efficient than a narrow-base thing. So Romney's plan is simply to lower rates, broaden the base. He wants to broaden the base by getting rid of deductions and credits. His latest idea now is to have some cap, so allow $20,000 in deductions. And so once you reach $20,000 in deductions, or 17, or 25, or 50, whatever it's going to be, once you reach that, then you don't get any more deductions. I would probably try to tweak that a little and use a percentage of income as opposed to a strict limit, but that's just my own preference. But so the revenues you're going to pick up are going to be from broadening the base, allowing rich people fewer deductions, and you'll be able to lower marginal tax rates, which means out of every dollar you earn, you get to keep more of the last one, which means there's more of an incentive to do whatever it is you're doing. And that will lead to positive effects on the economy. I mean, there's almost no, there is, you know, and you say this, so we say this on Romney, but what about Obama's tax plan? I mean, his plan is to raise the taxes on the rich, but to give a bunch of tax breaks to people below $250,000, who I would not consider middle class. I don't consider people in the top 20% from $100,000 to $250,000 necessarily middle class.
He's going to raise revenue by taxing the wealthy more.
Yeah.
And he's going to leave the middle class, everybody below $200,000, where it is today.
He said he's going to get rid of the Bush tax cuts above $250 and keep them below $250. Well, if you get rid of the Bush tax cuts above $250, you only raise $700 billion. The Bush tax cuts below $250, the total Bush tax cut cost is $3.3 trillion. So you're $2.4 trillion, 3.3 minus 7, $2.6 trillion short of a balanced budget tax reform. So I think...
Yes, but he's getting more revenue, which is part of the Simpson-Bowles idea. It's to get...
No, he's getting less. Romney's tax reform is much closer to Simpson-Bowles than Obama's. Simpson-Bowles actually says that we should never have high tax rates over, you know, their limit on the highest tax rate was 28%.
Let's go over here. We have a question over here. Thank you very much for your question.
Yeah, I just had a question for Dr. Green. In terms of the Fed's new announcement of buying mortgage-backed securities, what's your call on the mechanics of how that works in terms of helping to clear the housing markets? And, you know, because I'm sure you had quite a bit of background at Treasury with working with that type of issue.
Well, as a caveat, I was on the international affairs side, which didn't work on our debt management issues that closely. But I'll give it my best shot. Essentially, the point of having the Fed buy mortgage-backed securities is the same as China trying to buy U.S. dollars. Is you raise the price of it, which with the way bonds work, the higher the price of the bond, the lower the interest rate. And so it's really just an effort to drive down interest rates in the mortgage market, with the hope that that will then encourage people to buy more houses and invest more in our housing stock. And of course, the housing segment of the economy is a major employer that's been really hit. So if they were successful, it would be a good boost to the economy. The problem is, of course, that just by lowering interest rates, you're not necessarily making it easier to get, you maybe find it easier to afford a loan, but you're not necessarily making it easier to get a loan from the bank. And right now, our banks are really seem to be stuck in the sense that they're reluctant to lend a lot. I think some of these efforts to try to get some of the defaulted or underperforming mortgages to be able to take advantage of low rates and refinance may have a better chance of actually stimulating the housing market.
Very good. Over here, please.
Thanks for your comments. This is a question on the debt GDP ratio. When you showed the countries in Europe, it was about 30-40% debt to GDP for those countries. And in the US now, it's 100%, 16 trillion debt, 16 trillion GDP. So how does that limit our decisions, like how severe do spending cuts need to be, how severe do tax increases need to be, given that we're at 100% debt to GDP ratio, and the IMF has been making reports about it, and how will that affect international confidence in the U.S. as a country for safe investments?
Yeah, that's a very relevant question. The one thing that I would note is that on the graph, I wasn't showing debt to GDP levels. It was changes in the debt to GDP level from 2009 to 2011. So actually, Spain, Greece, and Ireland are well above, and Italy. Not Spain, sorry. Italy, Greece, and Ireland are well above 100% of GDP. So we are in that high debt camp at the moment, but it's not that we're so much worse off than Europe. But to get to the point of your question, the U.S. essentially at the moment is in this sweet spot where there's all this investment money that has to go somewhere. Countries, so maybe China has stopped accumulating reserves and is therefore buying a lot less of our debt, but there's still a lot of countries who are accumulating international reserves. Those have to go in high-level, highly secure, highly liquid assets like treasuries. They have to put them somewhere, and there's a limited pool in the world of where to put these funds, and essentially a lot of it winds up going into the U.S. just because we're so large and the surpluses in other parts of the world are so large that we, they frankly don't have anywhere else to go. So to some extent, this gives us a little bit more buffer than other places. Within Europe, you see, no longer are people putting their money in some of these southern European countries. It's going to Germany and other northern European countries. But there is a limit, right? I mean, at some point, you can imagine it will start to hit investor confidence. There is some automatic purchases through Social Security, and now an increase of the Fed balance sheet increased by $2 trillion from 2008 to the present. So that's a huge increase in absorbing more of our debt. But it's a real confidence game that's very difficult to call. At the moment, obviously our interest rates are at all-time lows, and so there's no indication that in the near term that markets are very worried. But it can't go on forever. It's difficult to give us a precise answer.
Maybe if I could just piggyback on that. given your background in Treasury, if you think about the concerns on that high ratio of debt to GDP, what effect does that really have on us as the world's preeminent power? At some point, do we start getting limited, and what kind of limits would that show up as?
So as long as our interest rates stay low, you have to worry about the kind of numbers that John presented, where you see your ability to, for the government to spend money on the kinds of things that we like it to spend on gets limited because they're spending so much of tax revenue, assuming you don't go off into the alternate weird trajectory where things blow up. You wind up spending all of your money on interest, and, just because the size of the debt is so large. So assuming you don't go off into that scenario, interest rates remain relatively low. It's manageable. But you know, there's I guess, you know, it's just clear that at some point you wind up with investors reluctant to invest in the U.S. economy, and interest rates will rise. And of course, interest rates rising hurts the economy quite a bit. There is some, you know, as I touched a little bit on the economic evidence, the evidence that economists have found on the impacts of high debt levels on economic growth. Mm-hmm. And so Ken Rogoff at MIT and Carmen Reinhart at, she just left Maryland, I think she's at Harvard now. Anyway, you know, have this very famous study where they go back and look at debt crises for the last 200 years, and they find significant impacts of high debt levels on economic growth. But frankly, those results are a little bit tenuous, I guess I would say, and it's just not, you can't say with absolute certainty as an economist that high debt levels will impact your economic growth. You could go a lot of different directions. So it really just depends. So essentially, it's a confidence game. At some point, if we lose confidence if the average investor, American or foreign, loses confidence in the ability of the government to meet its obligations, then we'll be in real deep trouble. And as long as we can maintain confidence, then I think we're okay.
Great, thank you.
Well, one other point, an interesting point on that is,
and then we'll come over here.
From a completely different perspective, historically, when you think about running high debt, and so when you owe foreign countries lots of money, so when they're your lenders, they gain some type of power over you. So after World War II, when Britain and France, we had lent them tons of money to reconstruct, there was a conflict in the Middle East with Egypt. And the Britain and France wanted to invade Egypt. We didn't want them to. And so we started selling their currency on the market in very large volumes, which immediately weakened their currency. They couldn't afford anything, and they pulled out. And so there is this thing we have to be careful with this financial warfare, where we can weaken ourselves militarily, or we can weaken our national security if we allow ourselves to take on too much debt.
Great. Ed, did you have a point?
I think, you know, I'm a reader of Neil Ferguson and the Harvard.
Can you get a mic or something? Yeah, so we can hear you. I thought I'd give the ambassador a question because he's
but I want to take
anxious,
it beyond.
And it's his house.
I want to test our two excellent Baker Institute fellows here in terms of their economic analysis, in terms of how you interpret how a historian, a Harvard historian, who's analyzed the rise and fall of empires, and he has, I forgot what the ratio of debt to GDP is, but he's done an analysis of the Greek, the Roman, the British Empire, the Ottoman Empire, pre-revolutionary France, and that when a country becomes so indebted in relation to its GDP, it is a sign of the decline of preeminence, where you cannot project power overseas, politically, economically, militarily. I guess what I'm hearing from you is that it's not as simple as that, because there's a perception of confidence and the factors you're bringing in. But what is your take on this thesis? Because I am a believer in American exceptionalism, in political terms, our Constitution, our values, and what we stand for. But what scares me as a citizen is I don't think we can be exceptional if the economic base of our country gets totally out of whack, like some of your charts. Then we too can be victims of preeminent decline.
We've got just a few minutes, so we'll do a quick cycle to answer the ambassador's question. And 2 people here, we'll get those in, but brief. Time's running out on the midterm. Think of it that way.
I think we're there. We're already discussing whether we need to cut $55 billion in military expenses this year. We're somewhat boxed in. We're facing a $202 trillion long-term debt, not just $16 trillion. I think we have already compromised our financial ability to be the world leader to some great extent. And now we have tough choices that stand in front of us.
I would say that, if we talk about the decline of the U.S., who is it that's replacing us? Europe is clearly, sort of in long-term decline population-wise. Their economy has not kept up for a long time. We're clearly talking about China coming in, and I think the rise of China is something that's going to happen, even if we didn't have this crisis, even if our debt levels were not so large. We're looking at inevitably a multipolar world, economic power world. I won't go into the more strategic question. But I also think that that's not necessarily anything we have to fear, that China is going to be, has the potential to be an economic power that could be, a great partner. So I'll stop there.
Okay, well, very quick cycle.
Professor Diamond, you said that there were like 3 things to evaluate a tax policy. One was efficiency, one was fairness, and the other one...
Administrative.
It was administrative.
How easy it is to administrate it.
And that's on the tax side. So
Yeah.
I'm assuming that on the spending side, there's also efficiencies of spending too. Are there more spending that is more efficient in the short term than the long term? Or, is education something we got to think about as being,
Absolutely.
Significant as you put $1 in and you get 8 out, as opposed to something else where you might get 2 out?
Yeah, absolutely. And if you think historically, why did the U.S., so we had high tax, this goes back to this question of, there were high tax rates and we did well. Well, after World War II, we faced high tax rates, but we did well. Well, we had more capital than any other country. We had a more educated population than any other country. We were the only country that at least allowed anyone to get a college education. No other country did that at that point. So education is a critical issue. And in fact, I would say that education may be the most critical issue. When you have 50 to 55% of your minority population not getting past 9th grade, you have a major problem. And there's no way, you can't afford that problem to continue forever. Something has to change. We have to solve that problem in order to keep moving forward.
Very good. Last question, please, sir.
You talked a bit about politicians possibly holding off on raising taxes for 10 years. Wouldn't politicians in general have an incentive to do that based on their short-term horizons, wanting to remain in office regardless of whether they are Democratic or Republican? And then I also had a question when you talked about Romney's plan to have a broader base with his tax plan. And while that may create more revenue, while fairness shouldn't be the primal concern, there is the idea, aside from economy, of the spread of income in the country. And you said that Romney would allow the rich, like higher income, to have fewer deductions, but they may already have, some of the perception may be that they have high deductions and the lower middle class are getting taxed more. And not to say that there's one solution or the other, but why is increasing the broader base and taxing the middle class to Romney's plan, but also taxing the higher income to the same extent as Obama? Why not to say that just make everybody unhappy to a certain extent?
That's a great question, Max. So, as a former student, it's always great to see former students excel. Look, there's a lot of ways to do it. So what I would say is, if you want to take away the deductions at the top end, I'm fine with that. But let's not raise the marginal tax rate. So instead of moving the high income tax rate from 35 to 44%, let's leave it at 35, but let's not allow a deduction for state and local income taxes, which only very, very wealthy pay. Let's not allow a deduction for mortgage interest on a mortgage principal that's over $500,000 or $250,000. Low-income people don't own $1 million houses. They don't have $1 million in mortgage debt. So let's cap how much of a deduction, let's cap the mortgage interest allowable to be deducted at $250,000. And then let's not allow the rich to take a deduction for the $1 millionth of debt that they borrow against their house. So those types of policies, like the home mortgage interest deduction, is ripe for reform because it's such an ineffective policy that doesn't achieve its main mandate, which is to increase home ownership among low-income people. All it does is encourage rich people to buy bigger houses. So that's a deduction that I think we could agree on scaling back, but not getting rid of, because the housing market is an important part of the American economy and we can't hammer it at a time when it's already down. But we could reform it in order to broaden the base so that we could at least keep the rates at the same level instead of allowing them to go up. But yeah, I mean, that's fair questions. I mean, fairness is a subjective issue. We all have different views on what's fair and what's not, and that's why we vote, and that's why the most important thing is for our leaders to take the different views and to come to some compromise and do something instead of just bicker and fight and stand in their corners.
Well, I think that's a great way to close the evening. Thank you for all of your questions. Thank you for attending this evening, and we look forward to seeing you at future debates, and thank you to our fellows.